to have you here. My name is Leyla Seka. I'm a partner at Operator Collective. I know most of you, hopefully. And today we are going to talk a bit more about angel investing and really getting into the legal side of investing and what that looks like. So at a high level, we're going to talk about some of the key legal considerations that you all should keep in mind before you do any financial transactions, and sort of what the forms of financing look like at early stages. So really, what does it look like when you angel invest, and how does the structure of that deal come together? And to do that, we have our amazing LP. Oh, wow, that was not what I expected. Okay, keep going, sorry. We have our amazing LP. One more. Oh, wow, I don't know where the intro slide went. Sorry, I got a little bit flustered there. I apologize. We have our amazing LP, Einat, who is a badass lawyer at Fenwick and West, and who spends most of her time talking to and representing the companies that we're all interested in investing with. So she's going to take us through some of the legal background and some of the details around how investing works, both as angels and as venture funds, so both as an individual and as Operator Collective, and then is also available to ask questions. And as you all well know, I will probably be busting into the middle and asking her questions at this point.
I hope so.
All right, lady, take it away.
Thank you, Leyla, and hello, everybody. It's a pleasure to be here. It's an honor to be part of this network and an LP and Operator Collective, and I really appreciate the opportunity to speak to you all. We're going to be talking about angel investing. What does it mean? What are the terms that you're going to see as angel investors? And also a little bit about what a fund looks at, which is a bit of a different perspective than what individual angel investors look at. So first, a little background. We have a couple of self-serving slides about my law firm, Fenwick and West. I won't bore you with that. Suffice it to say, though, I want you to have confidence that we know what we're talking about. We've been doing this for a long time. We are a tech firm, all tech, all day, every day, and you can see some of our logos. And so you should really have confidence that we do know what we're talking about. We've been doing this for a long time. So let's talk about a little bit about even before you decide to invest, and we'll go into the details of what the investment looks like later. But as you think about what to invest, I want you all to be aware of certain issues that you need at least to ask founders and companies about, and these are what we call diligence issue. Before an investment takes place, whether you're an individual investor or whether you're a venture capital fund, you will undergo a diligence process where you want to kind of look under rocks and just make sure that everything is in order before you put your money in. We all know that investing is a risky business, and so these are sort of ways to mitigate some of that risk. And as an angel investor, the diligence process you undergo is going to be less comprehensive and less exhaustive than what a venture fund will do, but there are still a couple of things that you want to be aware of. So let's talk about what those things are. So the first thing you want to make sure is that the company actually has a proper legal structure, right? A company is most often going to be either a C Corp, a C Corporation, or an LLC. And most often it'll be incorporated either in Delaware or in California. You want to make sure that the incorporation has been done and that you're not giving your money over to some individuals because you will be less protected. You also don't want to, you want to be careful. I don't want to say you don't want, but you want to be careful about investing into other types of structures like partnerships and things like that, because there are some both tax and liability issues associated with that. So what you want to make sure is that the company is incorporated, usually as a C corporation or sometimes as an LLC, before you go ahead and put your money in. And then the other thing, and by the way, these are things that are important to both angel investors and venture funds. You should also be aware that the reason we like C corporations more than any other legal structure is because down the road, after you make your initial angel or very early stage investment, the company is going to probably look for some institutional money from professional investors like venture funds. And venture funds, as a rule, do not invest in any type of corporate structure other than a C corporation.
Why do they only invest in C?
Because of the tax ramifications to their LPs. There's some, and we don't need to go into the details, but there are some flow-through tax consequences to an LLC and other types of structures, and so what they really want is a C Corp.
Gotcha.
And so that's a question you want to ask early on. And then the other thing that's most important, especially in the early stages, is to make sure that the IP that has been developed and created is actually owned by the company, because for most of these technology companies, of course, the IP is their key asset, and oftentimes that IP was developed by the founders prior to incorporation or by early employees, and so we want to make sure that everything has been assigned and is owned by the company. If you're going to do any diligence at all, that is the thing that you should be diligent.
And what do you just ask and look for papers?
Yes, so there are some basic papers you want to look to. You want to look to founders agreements and what we call proprietary information and inventions assignment agreement, and those are the documents that actually assign all of the IP that's been developed to the company.
Gotcha.
But asking is good too. I mean, you know, we find, of course, you need to be careful, but most founders will be upfront and tell you what they don't and do and don't have. So at the very least, ask the question if you're not going to take the trouble to read the documents, of course.
Gotcha.
We always recommend reading the documents.
What lawyer doesn't recommend reading the documents?
That's right. And then IP, really, this is a slide that just kind of talks about where the IP comes from, and as you can see, the IP comes from many, many different places. It comes from your founders, of course. It comes from the company's employees. It comes from third-party contractors and customers. And there is this, all of these boxes represent sources of IP. So as an early investor, you're probably not going to diligence every single one of these boxes, but you should be aware that they exist. The longer the company's been involved and the more outreach it has had into customers or vendors or contractors and the more employees it has, the more this web of IP becomes entangled. And so you just want to really be aware that the company IP is actually owned by the company. And then the other questions you want to ask is, what is the company's capitalization? Capitalization is really the shareholders of a company and the people who have rights to equity of the company. At the early stages, and I should also preface by saying that this talk is really going to be geared to very early individual investors. So at the very early stages where a company is just getting off the ground and looking for some early funding, this capitalization should be fairly simple because they're not going to have a lot of shareholders out there that they've raised money from. They're not going to have a lot of employees. They're most likely going to have a founder or a few founders and maybe some very early seed money. They may not even have any employees yet. If they do, they may have issued stock options, but that's really it. But you want to ask the question, what does the capitalization of the company look like? Who out there owns equity in this company? And how did the company issue that equity? Did it raise money? Are they employees or contractors? You want to be asking these questions.
This is the cap table question.
This is the cap table.
People call the cap table.
That's right. This is what people call the cap table, which at the very early stages is going to be on a basic Excel, and you should be able to get a copy of that very easily. So once you get the cap table, you can dig in a little bit deeper if you want to understand how that equity has been allocated and who owns it. There are some more, let's say, deeper diligence questions that you may or may not ask. They deal with employment law, compliance matters. If the company has a lot of employees or contractors, you may want to just make sure that they've got everything covered from an employment law perspective. And here again, most angel investors or early stage seed investors are not going to dig too deep into the company's documents, but they will ask the question. So you just want to do a little bit of homework about the company. That's really the message here.
So so just a recap of it. So the first thing is making sure that it's an incorporated company,
Yes.
and a C Corp, and in Delaware, California, or somewhere legit. Then you want to make sure that they own their IP.
That's right.
Right, and then you want to look at the cap table to better understand sort of who's inside the company.
That's right.
And how they're leveraged, and then additional diligence is making sure their employee practices and so forth.
Yes, employee practices and things of that nature. But I expect that in the early stages, there's not going to be a lot of that because they probably haven't been able to hire anyone at the very early stages because they don't have enough money. Which is why they're talking to you, because they need the money to grow the talent and develop the products. And by the way, you should also be aware that at the very early stages, the company's not going to have a long track record, right? It's not going to have revenues. It's not going to have sales and customers. It's really using that early stage money to develop all of those things. Venture funds often will wait until the company has some kind of a proof of concept or a market developed, so that before they put their money in. So they're going to be using your money, most likely the company, to build out its employee and base and develop the product.
Right, like at Operator Collective, we consider, in order to do an investment, they have to have repeatable revenue, product market fit, high conviction in the founders. So that was our thesis. So yeah, that makes sense.
And they use the angel, we'll just call you all angel investors, for lack of a better term. At the very early stages, they'll use the angel money to be able to develop all of that, so that they can approach venture funds and get some serious money. Okay, so let's talk about the financing deal structures. Once you've decided you want to put your money into the company, how does that actually happen? So let's give a little bit of background about what a company is. So as I said, a company is it's its own individual legal entity, and the ownership structure is based on shareholdings. So when you raise money, when you invest money in a company, or when a company raises money, what it's really selling is ownership percentages in the company. And there are really two main ways to structure deals. At the very early stages, which is what's relevant probably for most of this audience, the company will issue convertible equity. That means that they're going to take your money, they're going to give you a legal document in exchange for that, and that legal document is going to say, in exchange for your $100,000 or whatever it is, you will at a later point in time get stock. You probably will not get the stock up front, and there are reasons for that, which we'll talk about in a minute. The other type of deal structure or financing structure is actually a stock sale, where in exchange for your $100,000, you will be receiving stock in a company and valued at a pre-negotiated price, and that $100,000 will actually represent a certain percentage of the company. For the most part, the way that these deals have evolved over time is, as valuations have gone up and as venture funds have demanded to see more proof of concept and more repeatable revenue and that kind of those kind of metrics, the companies have started raising money from earlier stage investors who are not considered to be, let's say, professional investors like venture capital funds. And so they try to avoid having a negotiation on valuation at the early stage. So you will not know
how much it's worth,
how much of the company you are buying for that $100,000 initial investment. You will know that later when a venture fund comes in to negotiate that valuation, and your $100,000 convertible equity will then convert into stock that is issued in that financing at the negotiated valuation. So initially what you're going to get is you're going to get what's called a convertible note or a convertible safe in exchange for your investment. And let's talk about those two tools for a second. A convertible note is actually a note. It's a loan that you give to the company. You're going to have an amount that you're going to invest in the company, either on your own or in conjunction with several other lenders. And that note is going to earn an interest rate, and it's going to be a market rate of typically between 2 to 6%. These days we're seeing it closer to 6%. It's going to have a maturity, just like a real note, which is most likely going to be between 18 and 24 months. And then what will happen is, during that 24 months, if the company raises money on a negotiated valuation, your note will convert into the number of shares that is represented by your investment, your note amount.
But as an angel investor, it's like, okay, so I invested in something as an angel, and then let's say Operator Collective comes into round A and they set the valuation. I actually, as an angel investor, don't really have any say in how that valuation is set, right? You
don't. You actually will automatically convert. The things you have the power to negotiate at the very early stages are the economics of the note.
Gotcha.
And those things are potentially a discount on the conversion of the note. So if Operator Collective comes in down the road at a negotiated valuation of $10 million, you as an angel investor should, may be able to get a discount that will be set up front when you actually do your note, a discount off of that valuation.
Gotcha.
And the reasoning for that is because you as the angel investor are taking a bigger risk. Mm-hmm. You're coming in before there's any money at the table. You're coming in before somebody has actually vetted the company from a professional standpoint and decided that this company is valuable and will put money in. So you can negotiate a discount on the note, and you can negotiate a cap potentially on the note. And what the cap means is that your note will convert at a valuation of whatever you set the cap is. And
if I said that as an angel in that early example, if I said my cap is 8 million and Operator Collective came in and put in for 10, I would convert it.
That's right. You get the benefit of a $10 million cap, which means that your $100,000 buys you a bigger percentage than what your percentage would have been if you just convert at the Operator Collective valuation. And your ability to negotiate the economics of your note will really depend on how much you're putting in, how big of an investor you are at this note round, and how early the company is. If the company is confident that it's going to be able to raise money in the very short term, in just a few months after the note, and it's just using the note to kind of tie it over for a few weeks or a couple of months, your negotiating power is going to be much lower or much less. Then there's a question that comes up. Remember, we said you have a note, and that note earns interest over time, and it will automatically convert in what's called a qualified financing, which is a predefined term of a certain amount of money raised by a institutional investor or a venture fund. What happens, and it does sometimes happen, if the company meets with an exit opportunity before that financing occurs. It doesn't happen all that often, but it does happen. And what is an exit opportunity? Of course, typically an M&A, right? An acquisition. What happens if somebody loves this company and the technology so much that before it has gone off and raised money from an institutional investor or venture fund, it gets an acquisition offer and the founders decide that they want to go ahead and sell. You're not really in it for your 6% interest, right? We all know that. So you're really in it to make you're taking a big risk and you want to have a big return. So oftentimes into the note, you will negotiate a premium, which means that if the company sells before the note converts to stock, in the context of this qualified financing, you will be entitled to a premium of typically between 50 and 100%, but I've seen it go up to even 200% of your note amount. And, you deserve it because you took this very early big risk on this company.
Is there anything you need to look for when you're creating the convertible note to make sure that you get that payout? Do you have to ask for a provision, or is it typically in there?
It's typically in there. The company will be required to give you notice that it happens. You're automatically entitled to it. You don't have to call the note. You don't have to let the company know that you want your money back. It's typically an automatic provision in the note agreement.
Super.
The other type of convertible agreement, which is these days almost more common than a note, is a safe agreement. And it's very, very similar. This is something that was created by Y Combinator, and it stands for Simple Agreement for Future Equity. It's almost exactly like a note, but from an accounting perspective, it's not considered debt, it doesn't earn interest, and it doesn't have a maturity date. So you cannot call the note when the maturity date, arrives and you haven't been paid back. This safe agreement actually survives
acquisition
forever until either it converts in a financing, in a qualified financing, the same as a note, or there is some kind of an exit. And again, that safe agreement will be subject to the same negotiated terms, a discount off of the price that the venture fund pays in the qualified financing, a cap, and potential premiums in the event of an exit before the safe converts.
So in angel investing, which do you see more, safe or the note?
You see both, but I would say in this day and age, you see more safe than notes because it's better for the company. It doesn't have to carry debt on its books. It doesn't have to worry about default or having to pay the note back in the future in 24 months if there's no financing. And right now as everyone knows, we're in a boom and it's really a seller's market. So the company has more leverage and can insist on safes. It's a little bit easier. And also I think the negotiation of a safe, because of those two elements, is a little bit easier, faster, cheaper than negotiation of a note. Now these instruments really came about because of two things. One, the company doesn't want to negotiate a valuation with early angel investors, and the angel investors really don't have the experience and knowledge to be able to credibly negotiate valuation of the company.
How do they decide the company valuation?
That is a negotiation that is done down the road in a venture financing between the venture fund and the company. And that is really a reflection of how much ownership the venture fund wants to buy for its investment amount and how much ownership the company is willing to sell. So if you talk about, for example, if just for an illustration, if a venture fund wants to put in, let's say, $2.5 million, and it insists on getting 25% of the company, then it will do the math to get to the valuation so that it ensures that at a $10 million valuation, it will own it'll own 25% of it.
The valuations are very much guided by the venture firm that's leading the round.
Very much, and they're a sort of fiction because they're not necessarily tied to true metrics. It's really tied to how much ownership a company. Exactly. And so the safes and the notes came about because, number one, it's a bit early to negotiate valuation because there are no metrics really, and two, the company prefers to delay that, and oftentimes so did the very early investors prefer to delay that discussion for when a venture firm is sitting at the table. Remember, these safes and notes at the very early stages are not typically tools that are utilized by venture funds. They're tools that are utilized by individual investors. And they're much quicker and easier to negotiate because the true venture financing, as we'll see a little bit down the road, has a lot of terms and a lot of bells and whistles that we don't see on these safes. So they're much less expensive to negotiate, which makes sense for the company because it doesn't want to spend a lot of money on legal fees in the early stages. And we talked about this already. So advantages with convertible equity, convertible notes and safes is that there's just a few key terms to be negotiated so that the investment is done much faster and it's much less costly than a full-blown venture type of an investment. And the documents are also shorter and simpler and easier to understand. And the disadvantages, as you probably gathered from the discussion, are that you will not really know how much of the company you own until the venture fund comes in and negotiates a full venture round with the company. And the rights that you get are not going to be quite as involved and robust as the rights that will attach to the stock that you get once the note converts. So there are a few things that you're going to also want to consider at these very early stages of investment to make sure that you're as protected as you can be without having that, you know, full-blown equity stock issuance that you see in the venture financings. And those rights are threefold. One is pro rata, which we'll talk about in a second. Two is information rights, and three is guarantee that you'll be a major investor. Depending on how big of a check you're prepared to write, you will have more power to negotiate these three terms. So what is a pro rata right? A pro rata right is really your ability to continue to invest in the future in subsequent rounds. Typically, pro rata rights attach to the stock that's issued in a preferred financing, in a venture financing. They don't necessarily attach to angel investors that are investing in a note or in a safe.
So at Operator Collective, we always try to, you're our lawyer, so you know this too, we always try to get pro rata rights, so when the next round comes up, we can get our chunk of the round without having to fight with other venture funds.
That's exactly right. Yep. And a pro rata right, just so you understand, it doesn't necessarily mean that you get to maintain your percentage ownership share, ownership in the company. It means that if you own, let's say that the company did a convertible note round of $2 million, of which you own, or $1 million, of which you own $100,000, right? Because you invested $100,000 in this note round. It means that you will get to take 1/10 of the round when it actually happens. That's what a pro rata right is.
And you don't have to use pro rata either.
You absolutely don't have to.
It's just an option, right?
It's just an option. It's an option that's very important for venture funds, and it's also becoming increasingly important for very early angels.
And it's important for venture funds too, because if a venture fund, let's say, invests in an A and then doesn't invest in a B, that signals to the market that they don't have faith in the company, or isn't there some signaling that happens?
Yeah, so it's important for two reasons. One is if it's a really promising company, you want to be able to maintain a large percentage to, you know, be able to get as high of a return as you want. And down the road, you don't want to be cut out of your ability to continue to invest and continue to hold a significant portion of the company if you own one, or even just maintain your pro rata rights so that you can guarantee yourself a higher return. For the company, pro rata rights are a double-edged sword. On the one hand, it's important that your existing investors continue to invest, because if not, it signals to the marketplace that your existing investors who have a seat at the table and know the company maybe don't have faith in the company. On the other hand, the companies oftentimes find that they want some fresh money and fresh faces at the table. And so there's often in later rounds, a discussion that goes on, or a negotiation that goes on between the existing investors and the company about how much of a round they're going to take in order to make room for new money with new value that it can add to the company to sit at the table. So those are pro rata rights. And the other right you're going to want is information rights. Information rights, as a stockholder, you're entitled to limited information rights by law. You're not entitled to get things like board packages or quarterly updates or ongoing financial reports from the company. So oftentimes angel investors that want to be able to really keep an eye on their investment and keep an eye on the company's status and progress will ask for information rights. These are rights that venture funds will typically get, assuming that they invest a significant amount of money or sufficient amount of money, and that's a negotiated term in later rounds. It's also a negotiated term in these angel rounds. And again, your ability to negotiate for these rights will be directly correlated to how much money you're putting in. The more money you're putting in, the more rights you're going to have. Very tiny minority investors typically will not get information rights. The company's not going to want to go through the trouble, and it's not going to want that level of transparency between the company's financial status and operational status and minority investors.
So what's the main thing in information rights that I want to know?
The main thing that you want to know in information rights really center around the financials of the company. And again, this is often a highly negotiated item for companies because they're going to be particularly careful about how much information they put out there and to who. Gotcha. The third right you want to try to negotiate is a major investor status. In the later rounds, when the institutional money comes in, there will be a threshold for major investors, and the investors that put in the higher amounts, the greater amounts, will be entitled to major investor thresholds where they get all of these sort of added rights. They'll get robust information rights, they'll get pro rata rights, and some potentially additional rights. And so if you're going to put in a significant amount of money in this early note or safe round, you will want to try to negotiate major investor status that will give you those additional robust rights down the road. So that's really what you can expect if you're going to come into a company as an investor at the early rounds. As we said, your convertible notes or convertible safes are going to, at some point in the future, if the company has a preferred stock financing or a venture financing, convert into the same kind of stock that the venture fund's going to get in the later financing. So let's talk a little bit about what a preferred stock financing is so that you understand what to expect down the road. And there are different kinds of preferred stock financing. So at the earlier stages, you might see a Series C preferred financing. That is sort of a smallish priced round. In a preferred stock financing, the investor and the company will negotiate, as we said, on a valuation at which the investment is going to take place. And this is really correlated to how much of the company the investor is going to own at the end of the day and how much, of course, the company is willing to sell as well. In addition, to these financings, this company will issue preferred stock. And preferred stock, companies have basically two kinds of stock that they issue. There's common stock and preferred stock. Let's talk a little bit about what that means. Common stock is your basic stock that the company issues to founders at the very initial incorporation of the company and to employees down the road. And that stock really has very few rights that attach to it. It's basically a right to share in the economic success of the company, but you don't have a lot of rights on top of it. It's voting stock, so you will be entitled to vote that stock as if you're a common shareholder. But the other kind of stock that has more rights attached to it is the preferred stock, and that's what investors get. Common stock is also priced at a lower price than the preferred stock the investors get, and the reason for that is because the investors have negotiated for these additional robust rights, which we'll talk about in a minute, and so they pay more for the stock than your employees will pay for their stock. And let's talk about what those preferred stock rights are. So oftentimes there are economic rights and there are control rights. So economic rights are things like a right to get paid out, and let's just move this forward just a little bit. Economic rights are rights to get paid out based on your stock ownership before common stock gets paid out. So if there's an exit, for example, an M&A, let's say an acquisition of the company, the money will first be paid in the acquisition will first be paid to the preferred stockholders, and then from what is left over, it will go to the common stockholders. There are various nuances to this, which we won't get into now, but when your SAFE converts, for example, you'll be getting that preferred stock, which means that the investors who have put money into the company will get paid out before the founders and before the employees. So that is a key economic consideration that a preferred stockholder will negotiate. Like we said, a valuation is also a highly negotiated term, and that really just will solve for what is the ownership that the investor is going to get. And one other thing that is going to be negotiated is the employee option pool. The employee option pool usually, of course, represents a chunk of the company ownership that's going to go to the employees, and the investors will negotiate how much that pool is going to be and who is diluted by that pool. Is the dilution going to be really suffered by the existing shareholders and not the new money, or is everyone going to share in that dilution equally or on a pro rata basis? The other key terms that are going to be negotiated by a preferred preferred investor is governance. The venture funds and major investors in a company are going to want to have some control over the company's operations and governance, and that is because they want to babysit their investment. Sure. And they also, because they're professional investors, they also add some value and can help guide the company in certain directions. So the way they get the control that they need or seek is to, one, take board seats and sit on the company's board of directors, and two, have voting rights where they really get to have some blocks or controls over certain actions that the company may take. Again, when you, as an angel investor, own a convertible security that gets converted into preferred stock, your vote will count towards some of these governance and controls.
Can I ask you, so I have one question. I
think
we have another one too, but one question I wanted to ask you. So as far as board seats are concerned, if you're an angel investor and you get asked to be on a board seat, do you negotiate for some additional percent? Like, how does that work, you know, or? So
typically, an investor is not going to get additional equity, if that's what you're asking, for sitting on the board.
But an angel won't either?
An angel also will typically not get additional equity for sitting on a board. If you're an investor, you're sitting on the board because you're there to protect your investment, and so it's a benefit that you need and want, but not something that you would typically get equity for. Okay. As opposed to, for example, an advisor, which may or may not be an investor, but if you're actually having some kind of an advisory role with the company beyond the board of directors, you may, of course, get equity for that.
And I had one other question that someone asked in the room. Do you have any benchmarks on what the employee option pool should be or what that percentage looks like?
It fluctuates, but it's typically between 6 and 10%, and that usually comes off of existing cap table, not off of the new money. So an investor will likely say to the company, we're going to negotiate a pre-money valuation, and a pre-money valuation is the value of the company before the investment funds
before they raise the round, yeah.
So let's say if you're raising $2 million on an $8 million pre-money valuation, your post-money after the money comes in is 10 million, right? 8 plus 2 is 10. They're going to say that 8 million has to already take, that 8 million pre-money has to take into account an option pool that at the end of the day will represent between 6 to 10% of the company's fully diluted cap table. So the $2 million of that $10 million post-money will represent 20%. Gotcha. And the 8 million and the rest will be held by the founders, pre-existing shareholders, and an option pool that has to be at least 10% of that, if that's what they require. And that is a negotiated term in the financing round. You typically, as an angel investor, if you're going to do safe and convertible notes, you're not going to be negotiating a pool, but your safe and note will have reference to how you convert that money, whether or not the pool is taken into account when you convert or not.
Helpful. Great. Super.
Okay, so are there any other questions?
I think that's it for, I can keep asking you questions.
Okay.
Today, but I think that's for now.
So those are the key terms that you're going to see in a stock financing. Down the road, when we do the preferred stock financing and the angel investors convert their shares, they're going to see a lot more legal documentation in the round than they saw in their convertible equity round. There are 5 main legal documents which get very technical in preferred stock financings. Those are the stock purchase agreement, and the company's charter or certificate of incorporation, which is really the company's governing document. There's going to be a voting agreement, which deals with things like board seats. There's going to be an investors' rights agreement, which deal with some of those robust rights that we talked about that the preferred shareholders will have, and there's a right of first refusal and co-sale agreement. I think it's probably beyond the scope of this webinar to talk about the nuances of each one of these, but I'm happy to take questions if somebody has a specific question.
It's helpful just to know what they are and what to look for.
And in the deck, we'll have more details about this as well. These slides really just go into all of these agreements, and we'll send this out in the deck. One thing you're gonna see, and that's gonna be very important to you as a preferred stockholder and to the major investors in the round, and this is why you want major investor rights, is you're gonna want to have preemptive or pro rata rights if the company decides to issue more stock and raise subsequent rounds of financing. You wanna be able to exercise your pro rata rights, as we talked about, and participate in that financing. You're also going to want to right of first refusal on sales of or sales by other stockholders. If the founders, for example, decide that they want to sell some of their stock and they have the ability to do so, which is not necessarily the case, and oftentimes is not the case, but in the event that the founders or some of the common holders do have an opportunity to sell some of their stock, you want to be able to have a right of first refusal to buy that stock before it goes out into the ether and other people, third parties, buy it. If you're a significant enough investor, you may want to get board observer rights. I know Operator Collective likes to have observer rights.
We like board observer rights.
It does not give you a voting right at the board of directors, but what it does give you is a seat at the table during the discussions, and so gives you some more transparency into what the company is doing, and also an ability to guide and help the company if you have value to add. And oftentimes, and this is what's so unique for Operator Collective, is if you're an operator and you have some really on-the-ground experience doing things that are relevant for this particular portfolio company, then oftentimes they will welcome you on the board as a board observer so that you can add your insight and value at the discussions. And the other thing you really want to keep an eye on is the cap table, because at the end of the day, all of these investments translate into percentage ownership interests. And you want to make sure that, and they get very complicated, and so you want to make sure that somebody, if not you, somebody, your lawyer, your advisor, and the company's financial folks also are monitoring the cap table very carefully and doing the calculations carefully, because it's very hard to correct that down the road after the company has done multiple rounds of financing. And
we had a question. So someone was saying, assuming there are questions for you really quickly while we're chatting.
Yes.
And one was, what is a typical fundraising timeline for most companies?
So I think a company should really count on 3 to 6 months to raise money. It really takes time to pound the pavement and find investors, and that's true at all stages, by the way. That's true at the very early stages and also at the later stages. And the typical process is you'll find a lead investor who's willing to take ownership of the round, and they will negotiate a term sheet with the company. This is in the later in the venture round, right, as opposed to the angel investing stage. And they will spend a bit of time negotiating that term sheet.
And setting the valuation at that time.
And that term sheet will include the key, both economic and governance, right? So economic being the valuation, the liquidation preference, which means, you know, how much money do you get out of the company before the common holders or the earlier preferred holders get, and then the governance provisions as well, the control and the veto rights. They'll negotiate that, they'll sign that term sheet up, and then the company will continue to shop that term sheet around with additional investors that will follow the lead.
Yeah. What is MFN?
Yes, MFN is another important thing for angel investors to know. So as the company raises money in the initial stages, it often does so in chunks. So it will go to multiple investors to sign convertible notes and convertible safes. And you don't have, as an investor, you don't know exactly how many investors they sign with, or when they're even signing a convertible note or a safe with other investors. And each one of those may be subject to individual negotiations with the particular investor. So it may be down the road that the company will cut a better deal with a later investor. And so the way to protect yourself against that, maybe they'll have a lower cap, or maybe they'll have a higher discount off of the conversion price when you convert into preferred equity. So the way to protect yourself against somebody else being a better negotiator than you is to ask for MFN most favored nation status in your safe or in your convertible note. And I know that at Operator Collective, this is an important element for us, because we don't want someone else to get a better deal than we did just because we were nicer or more accommodating to the company. So basically what it means is if down the road a later investor gets a better deal than you did, then you will be entitled to the same terms.
That's awesome. Okay. One other question I had, what is the case when investors sell their shares? Like what happens when that goes on? Like if you're an investor and they decide they sell out their shares, how does that typically work?
So typically an investor will not sell their shares until an exit. But every so often you'll get some investors, you know, as in these days, we're living in crazy times.
Yes,
valuations are insanely high, and companies are staying private a lot longer and turning down acquisition offers a lot more often than they did. And so in this world, people hold on to their onto their stock for a really, really long time. And so both founders and early investors oftentimes get tired and need some liquidity. And so there may be opportunities down the road to do secondary sales where in a subsequent round of financing, an investor will want to increase its stake. And so it will buy shares from existing investors who have maybe gotten tired and want some liquidity and are willing to forego the big, huge return that may be coming down the road in order for a more modest return by selling to a new investor that's coming in a subsequent round of financing. And also founders will likewise need some liquidity. You know, they've maybe gotten a bit older, maybe they've had some children, maybe they want to buy a house. And so investors oftentimes will allow them to take some money off the table, and they'll buy some stock from the founders in order to give them a little more breathing room.
So I had one other thing, and that is, are investors responsible for compliance or legal issues of their portfolio company?
No, this is another benefit of having a C Corp or an LLC, right? There is a corporate shield between the investors who are shareholders and the company, and so the investors are not legally responsible for the company's actions. It is difficult to pierce that corporate shield or corporate veil, and so if somebody has a claim against the company, it is difficult for them to come after the shareholders in order to enforce their claim, or if they want to initiate any kind of litigation. But that's why I also say it is important for you guys to do a little bit of diligence on the company, because while it's difficult, it's not impossible to pierce that corporate veil. So you do want to make sure that the company is in good shape and responsible.
And then just sort of as a bit of a follow-on to that, if you do join the board as an investor, then you do have a certain amount of legal and compliance responsibility for the company.
That's right. That is also important to know. As a board member, you are no longer representing your investment in the company. As a board member, you have a fiduciary obligation to the company and to all the other shareholders, and you wear a distinctly different hat when you're sitting on the board. So you want to take that also into consideration when you sit on a board. Your responsibility is to all the shareholders, and you have a fiduciary obligation to look out for their interests, not just for your own stake. And so there are certainly cases where people who have claims have gone and filed lawsuits against the board of directors and for failure to comply with their fiduciary obligations. So you just want to be aware of that, and in the decision-making process, you also want to be aware of that.
Totally. You're amazing. I love talking to you. I could talk to you all day, and I bet everyone on the call could as well. And she's an LP, she's part of our community, she's also our lawyer, as we're all getting a sense of, so she's available. Please, we're gonna send out a survey after this call. Please fill it out and give us some more information. We were also talking today about maybe doing a session on stock options, just because a lot of employees, even those of us that are high up, ask questions about that. So if you're interested in that, please let us know on the survey. We'll also be following up tomorrow with an email and the deck and all of that, so you will have it. And if we go one step further, and just so you all know, we will be having another education series called Investing 101, which really focuses on how to build a portfolio construction, and really the process you go through when you're evaluating what startups you might want to invest in. And Iris Choi from Floodgate, who's a wonderful friend of Operator Collective, will also be joining us for that on Wednesday, March 18th. So mark your calendars. Let me just take this minute to thank you, Einat. I don't know what we would do without you. You've increased my venture capital knowledge tenfold in the time we've been working together, so I am deeply grateful. And if you guys do have questions or anything comes up that you'd like to ask Einat or me or anyone at Operator Collective, don't hesitate to reach out to all of us.
It's a lot of material, and there are a lot of nuances. So I do encourage you all to, reach out, and we'll also send maybe some resources for people to read up on and increase their knowledge in this area.
Absolutely. Well, I know my investor acumen went up quite a bit in this call, so I am deeply appreciative.
Thank you.
Thank you all very much for joining us. Hope you have a wonderful Wednesday and a great rest of your week.